Hello and welcome. Today, we're diving into something that affects just about every working South African: tax deductions. We're going to break down how you can legally lower your tax bill just by knowing what you're actually entitled to.
So let me ask you something right off the bat. Are you leaving money on the table when tax season rolls around? Because, getting a handle on your deductions is the key to making sure that doesn't happen. Okay, so what exactly is a tax deduction? Well, basically, it's an expense that SARS says, hey, you can take this amount off your income before we calculate your tax. For instance, if you earn 200,000 Rand and have a 20,000 Rand deduction, you're only taxed on $180,000. And the bottom line? Less taxable income means a lower tax bill for you. It's as simple as that.
Here's a great way to picture it. Think of deductions as legal, government-approved discounts on your tax bill. And just to be clear, these aren't some sneaky loopholes, nope. They're incentives, put there on purpose, built right into the tax system for you to use. And that brings us to what we call the deduction advantage. You see, it's all about why this stuff really matters. It's about shifting from just letting tax happen to you to becoming an informed taxpayer who makes the system work for you. I mean, that's what it's designed for, right?
Okay, so let's get practical. We're going to open up your tax toolkit and look at the most common and honestly, the most powerful tools you've got at your disposal.
All right, first up is a big one for a lot of people: your retirement fund contributions. Seriously, this is a classic win-win. You're saving for your future self, and at the same time, you're getting a tax break right now. So take a look at this. It shows you the rules perfectly. You can deduct what you contribute to your pension, your provident fund, or a retirement annuity, but there are limits. And here's the key. You get to deduct whichever is less of these two amounts, either 27.5% of your taxable income or that hard cap of 350,000 Rand per year. Okay, next on the list, medical expenses. Now, pay attention here because this one works a little differently. Instead of lowering your income, these medical tax credits actually reduce the final tax amount you have to pay. And trust me, that's a really powerful difference. So here's how it breaks down. On one side, you've got your medical aid contributions. For those, you get a fixed, set-in-stone credit every single month for yourself and your dependents. Easy enough. But then, on the other side, you have those out-of-pocket expenses. The stuff your medical aid didn't quite cover. For those, you might get an extra credit, but only if those costs go over a certain percentage of your income. All right, let's talk about a deduction that actually feels pretty good to claim: giving back to your community through charitable donations. But, and this is super important, you have to follow the rules here. First, your donation has to go to a registered public benefit organization, a PBO. Second, that PBO must give you what's called a Section 18A certificate. And finally, keep in mind that the total amount you can deduct is capped at 10% of your taxable income. Okay, what about expenses related to your job? Now, this one isn't for absolutely everyone. It's mainly for people who earn commission, or if your employer gives you a specific allowance for things like travel or using your own equipment. This table lays it out pretty clearly. For example, if you get a travel allowance and you use your own car for business, you can't just guess. You need a detailed, meticulous logbook of your business kilometers to claim those costs. And it's a similar story if you use, say, your personal laptop for work. You can claim for the wear and tear, but you'll need an official letter from your employer confirming that it's a requirement of your job. Okay, so we've talked about a bunch of what you can claim. But the how? Well, that's just as crucial. So let's go over the golden rules for claiming with complete confidence. It really boils down to 3 simple and non-negotiable steps. Step 1, know what deductions you're actually eligible for. Step 2, and this is probably the most important one, keep everything. Keep meticulous records and all your receipts. And step 3, be honest. Only claim what you're legally and rightfully entitled to. This next statement, it really says it all. It's the absolute golden rule of tax claims. Don't claim what you can't support. Think about it. If SARS comes knocking and asks for your proof and you don't have it, that claim is getting disallowed. It's really that straightforward. So what does that proof actually look like? Well, here's your checklist. For every deduction, there's a piece of paper: medical certificates and receipts for health costs, that Section 18A certificate for your donations, a super detailed travel logbook. You get the idea. You absolutely have to have the documents to back up your claims.
Phew, okay, we've covered a lot of ground, haven't we?
But look, the whole point of this isn't just to throw information at you. It's to empower you to turn this knowledge into your next smart move. And this right here might be the most important takeaway of all. Everyone's tax situation is different, it's unique. So while this explainer gives you a great framework, if you are ever in doubt about anything, the smartest thing you can do is check the official SARS guidelines directly, or even better, talk to a qualified tax professional.
You see, when you understand these principles, when you keep good records, and when you claim honestly, you're not just a passive participant anymore. You're in the driver's seat. You're ready to take control of your taxes. Thanks so much for joining me.